is the right time to invest in the stock market? Let's find this out using a few fundamental parameters. So our primary goal here is to understand when the index is overvalued or when it is undervalued using two specific ratios. One is the price to earning ratio and the second one is the price to book ratio. This is a very simple video to understand. We will not do any sort of calculations in this video. Our only objective is to evaluate the data or the ratios given to us and determine whether the index, which is Nifty 50, is it overvalued or is it undervalued. So what is the Nifty 50 index? I'm sure most of you already know what it is, but just for the sake of refreshing the memory, let me just jot down a few points so that I can explain the index in a much more refined form. Now, a combined list of the top 50 stocks in India is what we call Nifty 50. Now, the stock in the list are chosen according to their market capitalization and other relevant factors such as growth, earnings, and they are distributed in a weighted form. So, this list is represented as an index, and we judge the overall performance of the market, as in the stock market, on the basis of the index. Now, if we see that the index is performing well, we can say that the stock market is doing well. Similarly, if the index is not performing well, we can say that the Indian economy or the Indian stock market is not performing well. So now we get into the valuation part. Here we'll talk about the two ratios, but please understand that you do not need to memorize any of these ratios. These are just a mere slide so that you understand what we are talking about. Because later on, when you see the data, all you need to do is just look at the number and evaluate, which is very simple, whether the market is overvalued or undervalued. So the first ratio is the PE ratio, the price to earnings ratio. Now this ratio gives us an idea of what the market is willing to pay for the company's earnings. Now when we say company's earnings, we can simplify it, and just for the sake of this example, we will consider earnings to be the profits a company makes. So how many times the profit are you willing to pay to buy the company's share? This is noted as the PE ratio, and this is denoted in the times unit. The second ratio is the PB ratio, which is the price to book value or price to book ratio. Now this is a ratio which is used to compare a stock's market value to its book value. Now when I say market value, I basically mean the company's current market price or the share's current market price. And the book value is basically the total assets a company has minus the total liabilities a company has divided by the total number of shares which are available. So moving on, let us look at the formula for the price to earning ratio. Now we will talk about the formula a bit and then we'll move on to the datas. So the formulas are given just so that you understand what exactly is the PE ratio and how do we derive it. Now if you understand the denominator and the numerator of the formula, it will be a bit easier for you to come to a conclusion for the valuation of the index or the stock. It is very simple to understand, and I presume after watching the entire video you will get a good hang of it. The general formula for the PE ratio is the current market price of the share divided by the EPS or the earnings per share. Now this will give us a unit, which we will consider in times. So let's say you get a PE ratio by dividing the current market price of the share by the earnings per share at 5 PE. So basically, for every profit you make on the share, you are willing to pay 5 times the profit to buy the share. Think of it this way: the current market price of the share is trading 5 times the earnings it is making every year. The PE ratio of index is a bit different. Here, we do a sum total of the market capital. Now, by market capital, we basically mean number of shares outstanding into the current market price of the share. So we will do this for all the 50 shares, and this will give us a number. That number divided by the profit after tax. For profit after tax, again, in this situation, we'll take the sum total of profits of all the 50 companies, and this will give us the PE ratio of the index. So this is the last slide before we move on to the real actual data set. Before we do so, let us just get a understanding of when the ratios become overvalued and undervalued or fair valued. So on this table, you will see that any situation where the price to earning ratio is above 24, this signifies a overvalued market. Similarly, for undervalued, if the price to earning ratio is below 17, it is considered to be undervalued. And fair valued is within the range of 17 to 24. Now, similarly, for the price to book ratio, the overvalued zone is when the PB ratio crosses 4.5, and undervalued is when it is below 3.5, and fair valued is when it's in the range of 3.5 to 4.5. Now, I have skipped the formula for the price to book ratio because it is not that important. We will eventually understand it in the next couple of videos. But for the time being, it is only important that you understand these different levels. So this is a chart of the Nifty PE ratio versus the Nifty price line. Now the blue line here is the Nifty PE line and the black line is the Nifty price line. Now starting from the low of the PE ratio, which was in the month of June, the PE ratio at that point in time was 15. This was in the year of 2006. Nifty was at 2800 level approximately. From this point, if an investor had bought into the markets, since it was undervalued as per the previous data which we saw in the earlier slide, he could have held the share all the way up till 2007, where the PE ratio went into the overbought zone, which was 24. At that point in time, the markets were at 6,000 level approximately. But the market didn't stop there. It went on going all the way till 28, where the market became extremely expensive, extremely overvalued. This happened in the year 2008, in the month of January. Now, if you recall, this was the time where the American economy collapsed because of the bad mortgages and the collapse of the subprime mortgage bonds. The global markets were down, American economy was down, so did the Indian economy. The Indian economy toppled all the way from 6,300 level from the January of 2008 to the levels of 2,800. So you can imagine the amount of fall the market made during this span in time, in a span of 6 months, because of all the bad news and events which happened. Again, if you see, the PE ratio was extremely undervalued. It went below the level of 17. And this is where smart investors buy in. So if, let's say, an investor had bought into the zones of Nifty or the market during the December month of 2008, where the PE ratio was roughly 12. He held the shares approximately till it reached of PE 24, when 24 or 25, when like in the month of October 2010. That's where Nifty went back to 6,000 levels, and market was overbought, and then the markets fell again. Similarly, in the year 2014, the PE ratio was again undervalued, only at 15.6. If investors had kept or took new positions during this span in time, that's where the Nifty was at 5,500 levels. It went all the way up till 8,900-ish level. This happened in the month of March 2015. Then again, certain bad news has happened. The China market collapsed, some event happened, and the PE ratio was back again to the 19 zone. Now, the market bounced from 19 zone because another ratio, which is the PB ratio, is still in play. We'll talk about that in the next slide. So, the markets again, if investors had bought their holdings here and kept their holdings all the way till January 30th, 2018, that's where the PE ratio is at 27.5. This is the highest PE ratio we have experienced so far. Now, this happened just a couple of like the previous day of budget. Budget was on 1st of February 2018. Now, everything was overvalued during this point in time, and bad news of long-term capital gain came in, and all of a sudden, which was expected, the market made a small correction. It collapsed from 11,100 all the way down to roughly 10,100. So 1,000 points fall. And as per the 1st of June 2018, which was previous Saturday, the market is trading at a PE of 27 points or 27 times. So the market is still overvalued as per the PE ratio, but we need to look at the PB ratio also to evaluate a proper valuation of where Nifty is, whether it's overvalued, undervalued, or fair valued. So before we move on to the PB ratio, I just wanted to show you one more example of the Nifty's PE ratio. This is a heat map, and the heat map basically has the color combinations which suggest whether it's undervalued or overvalued. So the deep green sections where the PE ratio is below 17 are considered to be undervalued sections, and when it's above 24, it is considered to be overvalued sections. So just for one example, let's take the year 1999. In the month of January, the Nifty PE was at 12.44 level. So this is an extremely undervalued zone, and investors needs to buy into the market during this time. And in the year 2000, in the month of February, the Nifty's PE was at 27. And this happened during the time of Harshad Mehta, when the market prices or the share prices started rising haphazardly, and eventually the market collapsed. And when the markets collapsed, the PE ratio was down again, and smart investors would buy into the market during these spans of time. Like in, for example, the fourth quarter of 2001. Now looking at the current PE ratio for the market as of this video, we are in the month of June 2018. The Nifty PE ratio is at 27. This suggests that the market is extremely overvalued. But we will look at the PB ratio to come to a conclusion whether the market is actually overvalued or just one indicator is suggesting it's overvalued. So this is a table chart of the Nifty's PB ratio, or the price to book ratio. This is a heat map, and the heat map clearly suggests that the deep green sections are the sections where the market is undervalued, and the deep red sections are the sections where the market is extremely overvalued. So if you recall and remember that the zones for PB ratios are when it is above 4.5, it is considered to be overvalued, and when it is below 3.5, it is considered to be undervalued. So again, for example, we consider the first quarter of 1999 in the month of January. This time the PB ratio was 2.21, which is extremely undervalued. So this is where we buy into the markets. We bought into the markets and booked our profits when the PB ratio crossed the overvalued zone, which happened in the first quarter in the month of February of 2000, where the PB ratio was at 4.89, which is overvalued. This is where the Harshad Mehta incident took place, and we all know what happened after that. The markets fell. So this is a situation which we need to analyze in relation to the PE ratio to come to a conclusion whether the market is overvalued or undervalued. Now, in the year 2018, as of June quarter 2, the PB ratio here is 3.68. Now, this is suggesting that the market is still not overvalued. A good PB ratio will indicate that the earnings are supporting the price of Nifty. Now, since earnings are good, that is why the PB ratio is not overvalued. The moment the earnings of the company start falling, that's when the PB ratio will also fall. So, looking at the present data and the Nifty's PE ratio, it is 50% suggesting that the market is overvalued and 50% of data is suggesting that the market is fair valued. So now we need to see what happens in the upcoming few sessions, but it is quite natural a correction might happen, but overall the structure of the Nifty is somewhat stable, but eventually when the PB ratio also goes into the red category, that's when we know that the market is in full on danger and the time of exiting the market is near. So thank you for watching this video. The link to these two websites which I showed you are in the description. Do have a look at the data and track the performance of the Nifty's PB and PE ratio by yourself so that you understand what is the right time to enter into the market. Thank you.